I know I haven't made a video in a very long time, but I've been very sick and actually still sick and very busy. Very busy losing money as well. I'm no longer going to be selling call spreads again. I've lost quite a lot of money in my margin account. As you can see, the equity in my margin account is now 2,700 when at some point it used to be 12,000. So I usually sell iron condors on the general market, so SPX or SPY. So I sell the put side and the call side because I don't know where the market's going. So I usually go 30 days out and I pick a range. So as long as the stock trades within a certain range, I make money. So if the stock, let's say, is at 298 and I sell the put side at 290 and the call side at 310, I'm telling the stock basically to move within that range between now and expiry date. But what's been going on lately is that the market just keeps going up nonstop. I thought the market doesn't crash up, but apparently it does crash up. I mean, look at this. October 8th, it was trading at 288, the SPY, and now December 20th, so a little bit over 2 months, it's trading at 320. Look at this. So if you were selling call sides or call spreads for the past 3 months, you've always got tested, and that's exactly what happened to me. And I had a lot of call spreads, so they all got tested, and I tried managing them. Basically, most of them ended up closing for a big loss. So the way I've been managing them is if I sell an iron condor to begin with, so I've sold a put side and a call side, and the call side gets tested, the stock starts going towards the call side, then the put side is very profitable. So I start bringing it up all the way up to the same strike as the call side. That's the max that I'll bring it up. So at least this way, if I'm going into the trade with max loss of, let's say, $380, well, I've just reduced my max loss to maybe $300 or $250. But imagine that on several call spreads. So that's what's been going on with me. So I decided to change up my strategy again, but this time I'm doing more put spreads only. As you can see, the market goes up most of the time. There are occasions, of course, where it does go down, but past 3 years, past 5 years, you can see that it's always in an uptrend. A few times you're going to lose money over here, but even as you are losing money, if you keep selling put spreads, the put spread that you'll be selling when the market drops is going to be worth more because volatility, of course, goes up. So that means the premiums you collect is higher. So I've been selling put spreads, and I've been doing well with the put spreads, actually. If we look at a few examples here, so let's look at some SPYs that I've sold. Let's try to look at the same expiry date, of course. So let's look at January 8th over here. So you can see this SPY put spread, January 8th, I opened December 9th, collected $84. So I sold a put at 308, but then you can see that I closed it over here, December 16th. So I opened it, December 9th, I said? Yeah, December 9th, closed it December 16th. So closed it 7 days later. So a week later, I was able to close it for 29 cents. So more than 50%. And this was a 30-day expiration. Now what's great about this, although the commissions eat up a lot of the profits, what's great about it is that it's very scalable. Once the strategy gets going, nothing stops me from doing 2 contracts or 3 contracts or 5 contracts. So what I'm looking for is a consistent strategy. That's what I'm looking for. And just in the past 2 or 3 weeks, just selling put spreads only, no more call spreads, I've noticed that it makes more sense. As you can see with this one that I've closed in 1 week for more than 50% profit. January 6th, opened on December 6th, opened it for 78 cents. And let's see, when did I close it? So I closed it December 16th. And I closed it for 25 cents. So once again, more than 50% profit. Now I made a mistake. I should have combined these 2 trades together to save on commissions. Didn't think of it, but keep learning. Because as you can see, I've closed a bunch of them on the same day. So definitely could have combined all these. Could have saved easily $10 if I just combined them. All right, next time. This by December 31st expiration at 305 strike. It's a vertical put as well. 80 cents. I opened for 80 cents on December 2nd. You can see that I closed it right here, December 12th. So 10 days later, this put spread that I opened for 80 cents. So I collected 80, I closed it for 35. So making, once again, more than 50% profit on that trade. This vertical spread here, January 3rd expiration, collected $1. So I think on this day, the market dropped. So VIX was higher. So implied volatility was higher. So the premiums I was able to collect was higher. So January 3rd, at a 300 short strike on the SPY, collected $1, January 3rd expiration, sorry, but I placed this trade December 3rd. I was actually able to close it 3 days later. So from December 3rd to December 6th, I was able to close the trade for 42 cents. So made more than 50% profit in 3 days. I'm going into this trade with 30 days till expiration. I didn't end up waiting 30 days. In 3 days, I was able to get my 50% goal of the premium collected. January 6th, I already talked about. January 8th, I already talked about. So these are old iron condors that I was able to close for a profit before it got way out of control. But as you can see, if I still held on to them, the call side of 320 would have been in trouble. The call side of 318 would have been in trouble as well. So it's a good thing I closed them early on December 10th before waiting till expiration, because I would have been in trouble with this crazy market. So January 10, sold another put spread at 305, collected 76 cents. And look, I did close it January 10. I closed it December 16. So opened it December 11. 5 days later, I was able to close it for 25 cents. I collected 76 cents originally. So once again, making more than 50% of the premium collected initially. And I didn't have to hold it, once again, I didn't have to hold it till expiration, only held it for a few days. January 13, so on December 13, I sold a January 13 put spread. Expiration January 13, collected 75 cents. I was able to close it December 16. So 3 days later again, closed it for 38 cents. So closed it for almost half of the premium collected initially. And these are the last three here. These are 3 new put spreads that haven't been closed yet. But as you can see, the short strike is very high, 315, because the market was trading at 320. So I had no choice but to go this high. So their fate is unknown. I don't know what's going to happen with them, if I'll be able to close them for a profit, or they might be losers, but still have 30 days to go almost on each of them. If I look at the Qs, same thing. So you can see December 4th, I sold vertical put on the Qs with a January 3rd expiration at a 197 short strike, collected 82 cents. But then on December 12th, so 9 days later, I closed it for 31 cents. So collecting more than 50% of the initial premium collected. Then you can see December 11, I sold a vertical put on the Qs again at 198 strike with a January 10 expiration, collected 67 cents this time, so much less. But I was able to close it December 16, so 5 days later, not even 30 days later, but 5 days later, I was able to close it for 25 cents, collecting more than 50% of the initial premium collected. And once again, that's because the market has gone crazy. It just keeps going up in a straight arrow for some reason. And the last vertical put I have on the Qs is for January 17, collected 80 cents, but have not closed it yet. But it's already showing a small profit. If I go back to my positions, you can see the Qs here, January 17 vertical put. It's showing me already a small profit of about $25. But I try to close it for at least 50% of the initial premium collected. So it's not ready to be closed, but it's in the right direction at least. If I look at IWM, vertical puts, so December 4th, I sold a vertical put on IWM at a 156 short strike, expiring January 3rd, collected 77 cents. And then December 12th, so 8 days later, I closed it for 25 cents. So much more than 50% profit on the initial premium collected. And then December 11th, I sold a put spread on IWM again, expiring January 10, at a 157.5 short strike, collected 70 cents. So opened it December 11th, closed it December 16th. So 5 days later, I closed it for 30 cents. So more than 50% profit again. What's really great about this is that I don't even have to wait the full 30 days or even half the period of expiration. I end up closing it in a week. But once again, this is just because the market is rallying up and I'm selling put spread. So I'm selling a long strategy, a bullish strategy. And my last vertical put on IWM was open on December 18, but this one expires January 17. It's already showing a small profit. If I go back, I opened it for 76 cents. If I go back to my positions, IWM, as you can see, it's showing me a profit of about $24. Not ready to be closed, but at least it's in the right direction. I'm also proud of myself for this trade on Netflix. I opened December 18 for 97 cents. December 20th, I closed it for 48 cents. So 50% in 2 days, 50% of the premium in 2 days. I also like this trade here. So after earnings, Broadcom dropped hard. So I decided to sell a put spread at 300, expiring January 10th. So I did this December 13, going 30 days out. And then 3 days later, I was able to close it for 46 cents. So I collected $1.06, closed it for 46 cents. So once again, more than 50% of the initial premium collected in 3 days. Facebook was a good one as well. So December 4th, I sold a put spread at 190, expiring January 3rd, collected 84 cents. December 11th, so 7 days later, closed it for 50% profit, so 42 cents. And then December 13th, did the same thing for Facebook, a put spread at 187.5, expiring January 10th, collected 92 cents. And then December 18th, so 5 days later, I was able to close it for 35 cents. So really starting to enjoy put spreads. It makes more sense in the market that we're in. But what happens in a bear market? What if we're not always going up? So that's something to evaluate. But for now, this is a strategy that I'm going for. And I'm going to make a separate video explaining my new strategy and why I think it makes sense. I've actually downloaded historical data going back as much as I can just to see what would have happened if I've been selling put spreads for the past, 10, 20, 25 years. And I'll definitely present my conclusion in a different video. But for now, this is my strategy, is selling put spreads in my margin account. So the non-registered accounts would be selling put spreads, and then the registered accounts would be selling covered calls. So if you have any questions, leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.